What's up, everyone? It's Scotty with Money Vesting. In this video, we are going to be talking about another company that has absolutely gotten destroyed after hours, after the markets kind of digested that earnings report. The stock ended up selling off over 15%. This has been a company that's been highly requested from all of you. So I'm just kind of revisiting my analysis on this company. We'll be doing over some intrinsic value calculations, talk a little bit about their earnings, talk about, what went wrong, why is the stock actually selling off, and we'll talk a little bit about what to do next. So hope you guys enjoyed this video, find it helpful. If you do, make sure that you drop a like. Don't forget to subscribe to the channel. If you're just joining us for the first time, link to our Discord and Patreon is going to be down below if you're interested in joining. And there is, again, going to be the fundamental and technical analysis courses with a 40% discount link down below as well if you're interested in taking advantage of that. Over 80 plus lectures and 16 hours of content included. So the company we are talking about today is going to be Arista Networks, ticker symbol ANET, and trading at just a little bit under $135. Lots of volume today. It was down over 15.7% yesterday, and again, over 16 million shares traded, so 4 times more than the average 10-day volume. And if you take a look at the earnings, they actually ended up beating expectations, right? So $1.43 versus $1.38, and reported revenues came in at $1.35 billion versus $1.307 billion. So we got a beat on EPS, beat on revenue, but as I've mentioned in my previous videos, these beats and these misses are quite irrelevant. What really matters is that year-over-year number, right? Are we growing or are we declining? And in the case of Arista Network, they actually increased both revenue and earnings per share. We'll talk about that in just a minute. But I actually did a video on Arista Networks back in November of 2022. So it's been a while. But we talked about it, back in November of 22. One brand new growth stock I will buy. I love this. And this was, again, analysis of the entire company. We talked about the fair value at the time. It was closer to $115 per share. So that right there was the fair value that we talked about in that video, because at the time it was trading at $135 and we assumed a very reasonable 2020 growth rate and a P multiple. And it's kind of fun to go back and kind of watch those videos because, you have to really, it gives you an opportunity to kind of go back and, okay, what were the assumptions we were making back then? Is the company kind of meeting those expectations? Are we diverting away? What can we do differently? It's kind of good, right? Because it doesn't really matter whether I was right or wrong, but what matters is what can we improve with the analysis moving forward. That's really the whole purpose of kind of going back and revisiting your old trades, keeping a trade journal, keeping an analysis for your actual, or keeping a journal for your actual analysis and what was the reason as to why you took the investment in the first place. It's actually mentioned in one of the books that I was reading, Capital Allocators by Ted Seiss, and he mentions that having a journal and writing down all of your analysis and why you invested in the company is very, very critical, very helpful, because it keeps you away from a lot of the biases, right? Also, there's a hindsight bias. Hindsight bias is really where you change the reason for why you invested in the stock to begin with, right? So that journal really helps you understand, what were the reasons for that investment in the first place. And for me, kind of going back and checking out my older videos is always a fun part of this journey. So $150 was the fair value at the time back in November of 2022. And if you go back to where the price or how the price is traded, that video actually ended up coming out around here. So you can see that back in November of 2022, so right around this time when it came out, it was trading at $135, so right around this time, and the fair value was at $115, so actually ended up did pulling back here, 19%, came down to $108 per share, so it did drop 20% in the months that followed up after that video. So in the next couple of months, it did drop 20%, and then of course we saw a very, very nice rally of over 56% for Arista Networks, in this entire rally that we've seen since the beginning of this year. Year to date, Arista Networks is still green, over 9.8%, but of course it was up a lot more than 20% before this entire sell-off. So let's just kind of revisit what assumptions we can make now for this company, and I'll talk a little bit about the revenues and the earnings and all that stuff as well. So when it comes to the revenues, $1.3 billion. This is an increase of 5.9% year over year. Well, actually, quarter over quarter. Let me correct that. 5.9% quarter over quarter and 54% year over year. That's a pretty substantial growth. Margin was almost at 60%. Non-GAAP gross margins at over 60.3%. And non-GAAP net income was $272 million, or 85 cents per share. And GAAP net income was $436 million or $1.38 per share, which were both higher on a year-over-year basis. And the Arista CFO, Ita Brennan, says, we are pleased with the continued strong revenue growth in the quarter and with the team's focus on improving broader financial metrics as we move through the year. Now, we already know that semiconductor stocks, chip stocks are going to be under a lot of uncertainty, under a lot of pressure in 2023. We just learned from AMD as well, which was down over 6% after hours. And the CEO pretty much mentioned that amid macroeconomic uncertainty and the gradually recovering supply chain, Arista continues to bring innovative leading-edge platforms to market while delivering superior customer and financial outcomes. Our Q1 results illustrate this with continued growth in revenue and profits, and we did see very nice growth. So 1.3 billion coming from 877 million, not to mention that net income was almost up 100% from 272 million to 436. So if you do the math, 436 divided by 272, that's a growth of over 60% for the company, and diluted EPS going up to $1.38, and it's up from 85 cents per share. For the guidance, they are expecting $1.35 to $1.4 billion with non-GAAP gross margins of over 61%. This is for the second quarter. And if you take a look at 1.4 billion for the quarter ending in June, and you go back to what the company reported for the quarter ending in June, revenue was 1.05 billion. That's a 40% growth in revenue, right? 40% growth in revenue. And I'm assuming EPS is going to be up over 40-50% as well year over year. So this is reporting growth type numbers. And yet the market is not, market is reacting in a more negative way. And it's down over 15%. Now, I couldn't really find a very specific reason as to why the stock might be selling off. There wasn't anything specifically. Maybe it's the macroeconomic uncertainty. Maybe it's the semiconductor stocks in general, because AMD started dropping and Arista Networks dropping, NVIDIA was down today. So there's a lot of key different factors. It could be macroeconomics with respect to the interest rates, or with respect to inflation or further slowdown or recession. It could be a multitude of different reasons, but I couldn't specifically pinpoint to a reason as to why Arista more specifically was down over 15%. If you know of anything, just let us know in the comment section down below. But the balance sheet's fantastic, right? So we're sitting on marketable securities of 2.3 billion, cash almost $1 billion. That's over $3 billion worth of $3.4 billion worth of cash and marketable securities, with their long-term debt right now. Well, total liabilities, 2.2 billion. So on one hand, you've got cash and marketable securities of over 3.3 billion, and they're all liabilities, total liabilities at 2.2 billion, right? So they can pay off all their liabilities, total liabilities in one single day if they wanted to, simply by using their cash and marketable securities. And total assets at 7.5 billion. So very, very strong numbers there. Current ratio, quick ratio, well over 3, well over 2. And this right here is the consistent growth is what we have seen for Arista Networks. So it's not like a stagnant company, right? If you're thinking that Arista is like stagnant, it's not going to grow anymore, well, take a look at this. 361 million to 4.3 billion, consistent revenue growth. We've got gross profit also increasing. That's one of the reasons why I mentioned that I love this company in that other video back in November, because of these numbers, right? Operating income, very nice, consistent growth to the upside. We've got net income also from 42.5 million to over 1.3 billion. And not to mention the share count is very, very flat and stable at 317 million shares. Valuations, a little bit too high, I would say, like 30, 35, 27 times earnings is a bit on the high side, but it's not unreasonably high, right? It's not like crazy numbers. It is decent. And if you come over to enterprise value to EBITDA, returning at 20 to 29, price to sales is a little bit on the higher end as well, 9 to 11. And price to cash flow at 26 on a forward basis for the company. This right here is going to be the EPS expectations, 585 to 694, and revenue also expected to grow to over $7.7 billion by 2027. TradingView has a little bit of a different estimate for earnings growth. So we've got EPS growing from 458 all the way up to over $7 per share. That's going to be more of a 15% growth over the next 3 years for the company, right? 15% growth is actually quite good for Arista Network in earnings per share. And I wouldn't be surprised if it actually ends up being a little bit more, considering what I'm seeing every single quarter from the company. So let's just go with 12%, right? Let's just keep that very reasonable. Let's just go with 12% for the company. That's going to put us 2025 at 7.3%, and then continued growth of 12% to as much as $10.30 by 2028. And then now we go with a P multiple. I'm not going to go with 30, 25. Let's just go with 20 to start. And then discount rates, 12%, 10% margin of safety. And then we've also got share dilution, which is, I believe, what did we put for the last analysis? we put down share dilution minus 0.5%, because that's what the company's been doing, I believe, over the last 2 to 3 years. So we end up with a fair value of about $107, which is actually a little bit lower than the fair value, from back in November. And that's probably because the growth expectations have slowed down for the next 5 years for Ursa Network. Earlier, they were closer to 20%. So you can see that the growth expectations were closer to 20%. That's why the fair value is a little bit lower, but we are also taking into account the 2023 numbers and not 2022 numbers. So as numbers get bigger and bigger, the future growth slows down. And that's something that you have to understand from a law of large numbers standpoint. And that's why even with a 12% growth rate, the fair value might end up at close to $107. And the price right now is at 150 or 135. So 135 is where we're at. So about 20% more downside needed in order for this to be a good, reasonable company for the long term, at that fair value. So this right here is going to be that sensitivity grid. And again, you can do some analysis yourself. You can take a look at the different growth rates and different PE multiples and where you would be interested in taking advantage of Ursa Networks, because the company is pretty good, right? The company in terms of the fundamentals are very solid, but the valuation, the expected growth rate has definitely slowed down, which has resulted in the fair value to drop down a little bit. So 120 is going to be that support from a ascending support standpoint, the higher low. But below that, definitely watching 110, low 100s, some of those levels to really establish some bigger positions. $97, $98, like right around here, is some levels that I would be paying attention to for this company, because again, the company long term still has potential, and balance sheet's great, shares outstanding, consistent, buybacks, revenue growing, gross profit, operating income, net income, everything's growing. But it's just a question of what's the appropriate price for this company. So let me know your thoughts down in the comment section below. Support level is going to stay put at roughly around 120 from a more technical standpoint. And the fair value is going to stay put at roughly low 100s, pretty unchanged from last November. The only difference is that we are taking into account the 2023 expectations for net income, which is obviously a lot higher than 2022. And we're pulling back a little bit on the growth rate for the future, because as numbers get bigger, growth rates do decelerate. So again, hope you guys enjoyed this video, find it helpful. If you do, make sure that you drop a like. Don't forget to subscribe to the channel if you're just joining us for the first time. Link to our Discord and Patreon is going to be down below. As always, happy investing. I'll see you all in the next video.